Let's take a look at some of the market action here 90 minutes into the trading day. Stocks sliding in the second to last trading session of the year. The Santa Claus rally failing to ignite and continue a rally off a record year for stocks. While the highs of the year were partly driven by that AI boom, we're looking at opportunities in AI and beyond in 2025. Roosevelt, Bowman, Bernstein, Private Wealth Management Senior Investment Strategist. He's here on set with me to discuss. Roosevelt, great to have you here. So we are seeing a little bit of a sell-off in some of those major big tech names, but what are you looking at for the AI trade that's driven so many of the market rallies and gains that we've had so far this year? What could that AI trade look like in 2025?
Well, first, thank you for having me, Madison. And I think the AI trade, it will evolve, right? What we've seen thus far is this focus on semiconductors and cloud computing. It really is likely to be a trade that evolves into something that's focused more on power, cooling, the other parts of making sure that you are able to run your models and get results from them.
And what does that sort of initiate in terms of the trade? We've been looking at the top performers year to date today, and a lot of them are some of those nuclear power names that we've seen hyperscalers making deals with. Do you expect that trend to continue?
We do. I mean, I think part of the reason is that the power needs for these models is tremendous. You know, whether you're talking about a data center that's running a large language model, those data centers often use 50 times the power that a normal data center does. So you're going to have to look to other energy sources, and I think that's where there's some real opportunity.
A lot of opportunity, but also a lot of risk heading into this year. And one thing I've been thinking a lot about as we head into year end is how we started this year with so much recession risk priced into the market. We were talking to all of our guests about it. Does it concern you at all that that's been sort of priced out at this point?
You know, I'd say it is at odds with our forecast. We are anticipating slower growth in the US. And to your point, what's interesting is over the past couple of weeks, you've seen economic data slow noticeably, but interest rates have still moved higher. And it's still kind of, and to your point, also pricing out of Fed rate cuts. So there's lots of optimism, and in our eyes, maybe too much optimism in terms of where US growth is likely to be. We're anticipating slower growth over the course of the year in the US and certainly around the globe as well.
And that's really interesting because GDP growth is something a lot of sources tell me is their number one barometer for market performance. So how does that impact your call on market performance for the year?
Yeah, I mean, I think for us, it does lead us to a more defensive stance, you know, focusing on healthcare. There's been a lot of talk around healthcare and some weakness there, but both from a tactical perspective in terms of slower growth that we're anticipating, but also longer term, when you look at the demographics in the US, the aging population, we do see that as an attractive sector. And also looking at consumer staples, you know, those industries and those products where consumers are still going to buy them regardless of how they feel about their job prospects and kind of current income levels. I do think that'll be important going forward. When we look at the consumer right now, higher income consumers are driving a lot of the growth. Lower income consumers starting to pull back some. You know, they've had to rely on credit more, and some of that credit is certainly becoming more expensive.